Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams. Tonight we are discussing how to actually make money in property. How is it possible? So there's many ways to skin a cat, and it all boils down to your personal circumstance, your personal risk profile at the end of the day. There's many proven strategies to make money in property, but at the end of the day, it is all down to your individual personal circumstance and how hard you want to push the envelope. Tonight, we'll discuss the strategies which will include using rental income, equity, and also build to rent and build to sell models. These are based on modest portfolios as well as larger institutions such as Lendlease, Mirvac, and Meriton, who build to sell and rent. And at the end of the day, it's down to how big and you want to build your own portfolio. Ultimately, the more effort you put in, the more risk you take, the more reward you'll get at the end of the day. So we'll discuss these tonight. So first and foremost, you need to be exposed into the market. You need to buy property. You need to be across multiple markets, ideally. So Sydney, Melbourne, Brisbane, and their respective regions. In the metro markets, you get good exposure to capital growth. You can then leverage the growth out into the markets in the regions where you get better cash flow. But ultimately, you need to take action and you need to buy property and be exposed to multiple markets because not all markets perform at the same time. For example, right now we are seeing Brisbane, Perth, and Adelaide absolutely on a tear. They're going gangbusters. That doesn't necessarily mean you should be buying into those markets now because they are in the midst of an upturn. You want to get into markets before they go through a good bull run. So right now, we are now focusing on Melbourne, regional Victoria, Sydney, regional New South Wales, and certain pockets in Brisbane and in regional Queensland. We are still, but come 2025, we are no longer looking to invest in Queensland because it is almost set its course, and it's now coming to time to where it's almost too hot to start investing in that market. So picking the right market and being invested in the market in the first place is key. So first and most conservative way to make money in real estate is from the cash flow, also known as the rental income. So you buy a property, you rent it out, you collect the rent, and the rent will then be higher than the holding costs. If you are buying a property with a higher yield, so a 5+% yield, ideally 6, 7, 8% yields. So then the cash flow from the rental income that you collect services the interest holding costs, the maintenance, upkeep, the insurance, the property maintenance, property management, rates, strata, if applicable. The rental income services all holding costs, and then you can live off the surplus cash flow. This strategy is the most conservative way when it comes to property investment. It can take a longer period of time to develop a significant amount of cash flow to be able to replace your income. Typically, you'd need a good 7 to 10 properties and hold them for 15, 20 years before you can really see the fruits of your labor if you're solely relying on a cash flow model. So because you can pay down the debt with the rental income, and if you're holding it for a 25, 30-year loans, and at a point in time, once the rents rise and the mortgage is then paid down, you get a decent enough cash flow, then you can live off. That's the most conservative way. The next way to make money out of real estate or property investment is to release equity, which is what I do. I do a combination of both, which we'll get into in the further slides. So releasing equity is by refinancing the loan after a period of time. As the property value increases, you can refinance the loan. You can draw more equity out of the property by increasing the loan against that asset. The banks then debit the extra funds into your account, you increase your loan, and you can use that money to both reinvest to keep buying more property, but you can also use that money as discretionary spending. So it's another way of using the gains out of your portfolio, and it's essentially using money, debt, which is non-tax deductible dollars, because it's debt. It's not a earned income, it's a passive income. And you can use that as well to use as an income. So how do you do this? Releasing equity is, as an example, if you have a property that is worth $1 million and you have an existing loan of 500,000, you can, hypothetically speaking, leverage the property up to 80% of the value, so 800,000, provided you got the servicing, and then borrow another 300,000. So the banks will lend you another 300 grand against that property, and they'll debit the cash into your account. And then you can use that to reinvest, but then you can also use that for your lifestyle, your discretion. You can use it for buying cars, go on holidays. You can use it to cash flow your properties as well. And provide the values continue to rise 7 to 10% a year, and you're only using a portion, say 2 or 3% of the equity release per year, and you're using the equity to cash flow your portfolio, but also service your lifestyle, you can use the equity. So ideally, this is what I do, is I use both the cash flow. As the rents rise, it cash flows the additional loan repayments when I release the equity. So property typically goes up 7 to 10% on average per year. So once you build a substantial portfolio of 5 to 6 million bucks, and it's going up by 7 to 10% a year. So say you hold $5 million worth of property, it's going up by, say, 7-10% a year. That's, call it 3 to 500,000 a year. You can refinance your portfolio and draw 100 grand worth of equity out every year and still be less than how much growth you're getting, because the portfolio is going up by 4 to 500,000 a year. So you're using the equity, you're drawing the equity, you're using that, but then your cash flow is then servicing the increased loan. So you're balancing both the higher mortgage repayments with the increased rental incomes that you're receiving every year. So as you keep growing and the portfolio keeps growing, rents keep rising, you can keep refinancing your loans, drawing more equity, and the increased rental income and cash flow services the increased debt. And essentially that money is non-tax deductible money. Yes, you will pay 5, 6, 7% interest, but it is, that interest cost is less than paying 30, 40, 50% tax on earned dollars. So it's another way of the wealthy actually use equity to grow and build their wealth, but also service their lifestyle. It's why you see the biggest investors, property investors in the world, such as Robert Kiyosaki, Donald Trump, getting a lot of flack by the mainstream media, for not paying much tax. And the reason for that is they borrow money from the banks, use their assets as security, use that money for reinvesting to build their portfolio, but also to service their lifestyle, which is a very small run rate or cost compared to the value and the run and the income that their portfolio generates. And there's minimal tax because there's no tax. There's no tax on borrowed money because you're essentially borrowing from your future self. Yes, you pay your interest, but it's a lot less than paying 30 to 50% tax to the ATO for earned income. So that's the ideal position you want to be in. You want to be in a position where you can continually borrow more money against your portfolio, use that to reinvest, but also discretionary, but then balance it with the cash flow. So your portfolio always sits in a neutral to positive position, but you're using the equity to keep growing and service your lifestyle. If you want to keep pushing the envelope even further, you want to potentially get into property development. So there'll come a time where if you're exposed to multiple markets, so if you're exposed to Brisbane, Sydney, Melbourne, and the regions, not every region outperforms at the same time. For example, right now we've got Brisbane going gangbusters and Queensland going gangbusters. We've got Sydney and New South Wales buoyant, but pretty well flatlining, not going backwards, but pretty buoyant and flatline. And Melbourne is pretty stagnant and if not going backwards. So you got three different markets that are performing completely differently. So if you're exposed in all three markets, it makes sense to refinance, deploy capital into Victoria and Melbourne when it's soft, because you want to buy in soft markets. You want to get a good deal, as well as Sydney and New South Wales. But also when markets are going gangbusters like Brisbane now, it makes sense to start developing that. So instead of going like 99% of people do is they like to jump into markets where they're going gangbusters because they get FOMO and fear of missing out, and they think this is the time to buy when everything's going stupid and crazy and going gangbusters. If you got into those markets 5 years earlier than when they actually kicked into gear and started going gangbusters, now is the time to start developing in those areas. So if you bought a property for 200 to 250,000 2 or 3 years ago in regional Queensland or in Brisbane, you would have the asset already getting that substantial growth. You would then have the option to either subdivide, so cut the property in half to build a second house, or even knock it down to build 3 or 4 units. So you can increase your exposure in that market that's going up, but get it at a wholesale price. So instead of going and buying another house for 600,000-700,000, you could subdivide and build a second house for half the cost. That's property development. So you can use that strategy to then create more stock, create more exposure, create more rental income. And you can either use that to rent that new property out, so a build to rent model. So once the market moves, develop the site to rent it out to create another cash flow, and you're getting it at half the price, you're getting it at wholesale price, or you may even look to sell. So build to sell. So once the market moves, you might want to develop the site to rent out for a period of time, or even sell down to pay down debt, raise cash to then deploy into a softer market. You want to buy in soft markets. It's like Warren Buffett's famous quote is, you want to be greedy when others are fearful, and fearful when others are greedy. Right now, I am fearful of Perth, Adelaide, and soon to be Brisbane, and I am greedy right now of Melbourne, regional Queensland. I am super greedy because everyone is fearful. There's a $50,000 land tax threshold. Everyone's talking down Melbourne, Victoria. Everyone's running scared. Yes, the market might stagnate for the next 3 to 5 years and go flatline or backwards, but that's the best time to buy it, provided you got a long-term horizon, which if you're looking to buy a property, you should. Property investment is a long-term investment. It's something you do over a lifetime. It's not day trading. If you want to day trade, go and buy Bitcoin or something else like that. Property is a long-term investment. So 3 to 5 years of stagnation is not a big deal. That is the time to buy. When everyone is scared and running for the hills, that is the time to be doubling down and getting greedy into a market. Where markets start going gangbusters like Brisbane, Perth, Adelaide are now, and you can't even negotiate for a property because it's sold within 2 or 3 days, that is when you want to run for the hills, because you know it's about to top out, and then if you overpay, it might stagnate for 10, 15 years before it goes through its next bull run. So you want to get into a market before it goes through that gangbusters boom times and before it becomes mainstream media. And ideally, you want to get into a market where everyone is talking it down and not everyone's even thinking about it. That brings me to the 18-year land cycle. So probably should have switched slides before I started discussing that before. But yeah, essentially, we are on the yellow marker now, based off the 18-year land cycle. The 18-year land cycle is an average cycle of never less than 17 years and never more than 21 years, and on average 18-year cycle that commenced in 1800 in the US, UK, and Australia, and is now actually early stages of India that will eventually take over China as the leading economy. So I use this as a framework to work out the macro market to select to start investing in. I started my investment journey back in 2017, buying in regional New South Wales, and then I actually came across Fred Harrison and Philip J. Anderson and Akil Patel in 2018, luckily, and I got across this 18-year land cycle. And at the stage, I put all my super into cash into mid 2019 because I was preempting the mid-cycle slowdown. Because during the mid-cycle slowdown, stock markets take a 50% hit and super as well. So I moved stocks into cash and super into cash, avoided the 40, 50% decline. I then reinvested into the stock market and put my super into the ASX 200 in 2021. Probably a bit early. Probably should have held back till 2022, but you live and you learn. Still avoided a good 20 or 25% correction, and have it had a good run from 2021 to date. But then I also use this both to manage the liquid assets, but also how much debt you want to carry, and also where I think interest rates are going and what macro market to focus on. So I started doubling down in Brisbane between 2020 to 2023. December last year was the last one I bought up in regional Queensland. Recently, I've bought now in regional Victoria. So from now on, I am looking to, personally, I'm buying in Melbourne and Victoria. They are very undervalued markets, and Sydney to capitalize on the next recovery, which will happen from 2028 onwards. So there is a little bit more growth to be had, I'd say, in Brisbane, but from 2025 to 2026, that is the winner's curse, where every man and his dog is going to be rushing into the likes of Brisbane, Perth, Adelaide. It's when your hairdresser, your baker, your butcher, with all due respect, but we're giving you property advice and everyone will be talking up these markets. But the reality is they will get into the market when it's at its top, and then we'll be going through the next land-driven downturn, which will be the biggest in history, followed by the biggest boom in history. And those that get into the market at the top will most likely not be able to hold on to the property long term and probably get wiped out. So Brisbane, Perth, Adelaide are not necessarily the markets that you want to be focusing on in the next coming years. It's Sydney, Melbourne, and their respective regions to capitalize on the next bull run that they are scheduled to have post 2028 based off the 18-year land cycle. So this is the information I use. It's based off a lot of history and data. It has done me very well since I commenced investing, and it gives me a lot of clarity, and especially with interest rates too. So I think interest rates are going to keep rising until 2026, and if not, maybe a bit further. I don't see them going down because inflation is going to remain elevated. The RBA is talking about services inflation, which is rents. So rents are rising. The reason why rents are rising is the lack of stock, but also there's an underlying land cycle where we are in boom times now, and they are behind the curve. Realistically, they should have the cash rate higher, and they don't know yet. And until 2025, 26, and they're going to have an old shit moment, and then they're going to be jacking rates up like no tomorrow, and then we'll go through the next 1991 recession we had to have. And people that are over leveraged, that have one house, that they're solely relying on their personal income with a big fat mortgage, they're going to really feel the pain. So my strategy is diversify across multiple markets, use the cash flow from multiple properties, also release equity, cash up to allow you to sail through the wind, use some of the equity as well for discretionary if you like to, also to then start developing in Brisbane once we go through the real heat. So I'm not going to buy in Brisbane, but I'm going to start developing in 25 and 26, but it makes sense because properties will be double, triple the value I paid for. So it makes sense to build more stock in those markets and get the exposure and get the gains and get the rental income from those markets, and then increase my portfolio, gain more titles by subdividing so that I can go back to the bank and draw more equity and leverage those titles up and use the security to then redeploy into Victoria and New South Wales, Sydney and Melbourne in suppressed markets. So that's how I see the market playing out. That's how I plan to make money in the coming years. Just a disclaimer, this is by no means financial advice or general advice. This is my story. This is how I look to make money in property investment. If you are looking to buy an investment property, best to gain legal, financial, investment tax advice before making such purchase. If this resonates with you, I also provide buyer's agent services. So hit me up if you are looking to buy your next investment property and you need any support or help from that perspective. Happy to help, happy to chat any day of the week. Until next time, thanks for watching. See you then.